For the first time in 80 years, the United States dollar is no longer the dominant currency in nearly a third of all global trade. That number is not from some alternative news site or some anti-American economist with an agenda. It comes directly from data published by international financial institutions and cross-border payment tracking systems that monitor every single major trade transaction on this planet. 30%. China's yuan, also called the renminbi, is now being used to settle 30% of global trade transactions, and the number is climbing every single quarter. This is not a future threat. This is not a projection. This is the scoreboard right now. And if you are an American, if your savings are in dollars, if your retirement is priced in dollars, if your entire financial life is denominated in dollars, what is happening in that number is the most important economic story of your lifetime. Stay with me, because I'm going to walk you through exactly how this happened, exactly why it is accelerating, and exactly what it means for your purchasing power, your savings, and the country you live in. Before we get into the data, drop a comment right now and tell me where in the world you're watching this from. Whether you are in the United States, in Europe, in Asia, in the Middle East, in Latin America, wherever you are, type your location in the comments below. This story about the dollar and the yuan is hitting every country on this planet differently, and I want to see exactly how far this community reaches. Tell me your city, your country, and while you're there, tell me this. Do you think the dollar will still be the world's reserve currency 10 years from now? Yes or no? Drop it in the comments right now. And if you're not subscribed yet, fix that right now. Hit subscribe and turn on the bell because this story is moving fast and you do not want to get the next update a week late. To understand the full weight of what the 30% number means, you need to understand what the dollar's dominance actually looked like and how completely it shaped the world you grew up in. Because most Americans have never had to think about this. The dollar's role as the world's reserve currency has been invisible, like gravity. You do not notice it until it weakens. And right now, it is weakening in ways that have never happened before in the post-World War II era. The story begins in July of 1944. The Second World War is not yet over, but 44 Allied nations send representatives to a small resort hotel in Bretton Woods, New Hampshire. And in those conference rooms, they make a decision that will shape the global economy for the next 8 decades. They agree that the US dollar will be the world's reserve currency, the anchor of the international monetary system. Every other currency in the world will be pegged to the dollar, and the dollar itself will be backed by gold, with the United States guaranteeing that any country could exchange dollars for gold at $35 per ounce. This agreement did 2 things that no other event in financial history had ever done. First, it made the dollar the universal language of global commerce. Any country that wanted to buy oil, buy grain, buy manufactured goods, buy anything across international borders, needed dollars first. You converted your local currency to dollars, then used dollars to complete the trade. The dollar became the middleman in every major transaction on Earth. Second, it gave the United States an economic privilege that economists later called the exorbitant privilege. Because every country needed to hold dollar reserves, there was essentially unlimited global demand for American currency and American debt. The United States could borrow money from the entire world at lower interest rates than any other country. It could run trade deficits and budget deficits that would have bankrupted any other nation. It could print money in ways that other countries could not, because the world always needed more dollars. In 1971, President Nixon ended the gold backing of the dollar, what became known as closing the gold window. From that point on, the dollar was backed not by gold, but by something more powerful: the fact that global oil trade was priced exclusively in dollars. If Saudi Arabia wanted to sell oil to Japan, the transaction happened in dollars. If Nigeria wanted to sell oil to France, dollars. If any country on Earth wanted to buy energy, the most essential commodity in a modern industrial economy, they needed dollars. This became known as the petrodollar system, and it locked the dollar into global commerce even more completely than the gold backing had. For 50 years, that system held. The dollar never fell below 50% of global foreign exchange reserves. Most of the world's commodity markets, oil, gold, copper, wheat, iron ore, were priced in dollars. The Society for Worldwide Interbank Financial Telecommunication, the SWIFT system, which processes virtually all cross-border financial transactions between banks, was dollar-centric in its architecture. The International Monetary Fund, the World Bank, the Asian Development Bank, every major multilateral financial institution operated primarily in dollars. The dollar was not just the world's reserve currency, it was the world's financial operating system. And now that operating system is being replaced, slowly, partially, but unmistakably. And the speed of the replacement is accelerating in ways that were not anticipated even 3 years ago. So how does a currency that has been dominant for 80 years start losing ground? It does not happen with a single dramatic event. It happens with a series of decisions, each one made for rational, self-interested reasons by individual countries and companies that collectively add up to a structural shift that cannot be reversed. Let me walk you through the specific mechanisms that have driven the yuan to 30% of global trade. The first mechanism is the Cross-Border Interbank Payment System, CIPS. China launched this system in 2015 as a direct alternative to the dollar-based SWIFT system. CIPS allows banks and corporations to settle international transactions directly in yuan without converting to dollars, without routing through New York financial institutions, and without being subject to U.S. oversight or U.S. sanctions. In 2015, CIPS processed a relatively modest volume of transactions. By the end of last year, CIPS was processing the equivalent of trillions of dollars in annual transaction value. Over 1,500 financial institutions in 110 countries are now connected to CIPS. Every institution that joins CIPS is one more institution that can conduct trade in yuan without touching the dollar system. The infrastructure for a parallel financial system now exists. It is operational, it is growing, and the United States has almost no ability to stop it. The second mechanism is China's bilateral currency swap agreements. Over the past 15 years, the People's Bank of China has signed currency swap agreements with over 40 central banks around the world. These agreements allow the two countries to exchange currencies directly, without converting to dollars as an intermediary. Argentina has used its swap agreement with China to pay for Chinese imports in yuan when it was running low on dollar reserves. Pakistan has done the same. Several African nations have used their swap lines to settle trade with China entirely in local currencies. These are not insignificant economies. Argentina is one of the largest economies in Latin America. Pakistan is a country of 230 million people. The network of bilateral swap agreements has created a web of direct currency relationships that bypasses the dollar at hundreds of billions of dollars in annual trade value. The third mechanism is the most consequential, and it is the one that should alarm anyone who understands how the petrodollar system works: Saudi Arabia. The anchor of the petrodollar system, the country whose 1974 agreement with the United States to price oil exclusively in dollars created the foundation for dollar dominance, Saudi Arabia began accepting yuan for Chinese oil purchases in 2023. This was not a small transaction. China is Saudi Arabia's largest single oil customer. The volume of Chinese purchases from Saudi Arabia that are now being settled in yuan is measured in tens of billions of dollars per year. When the country that was the architectural keystone of the petrodollar system begins trading oil in a different currency, the signal it sends to every other oil producer in the world is impossible to ignore. Russia accelerated this shift dramatically following the Western sanctions imposed after the invasion of Ukraine. Before 2022, approximately 70% of Russia's export revenues were received in either dollars or euros. By the middle of 2023, that number had collapsed to under 50%. Russia began pricing oil sales to India in rupees. It began pricing sales to China in yuan. It began routing transactions through CIPS to avoid SWIFT. The forced decoupling of Russia from the dollar system became, paradoxically, the most effective advertisement for the dollar alternative infrastructure that China had been building for a decade. Russia's experience demonstrated to every sanctioned country, and to every country that feared future sanctions, that an operational alternative to the dollar system existed and could be used under adversarial conditions. And that demonstration effect changed the calculus for dozens of countries that were not themselves sanctioned, but were watching carefully: Iran, Venezuela, North Korea. These were already outside the dollar system by necessity, but the more significant audience was the countries that were not sanctioned. Countries like Brazil, India, Turkey, South Africa, Indonesia, that watched Russia get cut off from the SWIFT system overnight and began asking themselves a very uncomfortable question: what happens to us if we ever find ourselves in a geopolitical dispute with the United States? What happens to our economy if our access to the dollar system is used as a weapon against us? The answer those governments reached quietly and without press conferences was: we need alternatives. We need to reduce our dependency. We need to hold fewer dollar reserves and more reserves in other currencies, other assets, other systems. Now, here are the layers underneath this story that the mainstream financial media is almost entirely missing. The first hidden layer is what is happening inside the BRICS expansion. BRICS, originally Brazil, Russia, India, China, and South Africa, expanded in 2024 to include Saudi Arabia, the UAE, Iran, Egypt, and Ethiopia. The expanded BRICS bloc now represents over 30% of global GDP and over 40% of the world's population. And the explicit agenda of the expanded BRICS bloc is financial de-dollarization, not just reducing dollar reserves, not just using alternative payment systems, but actively constructing a new multilateral financial architecture, including the possibility of a new trade settlement currency that operates entirely outside the dollar system. The details of what this new architecture will look like are still being negotiated. But the political will, backed by the combined economic weight of a third of global GDP, is now unambiguous. The second hidden layer is what this does to U.S. government borrowing costs. Remember the exorbitant privilege I described earlier? The ability to borrow at low interest rates because the whole world needed dollars? That privilege is directly tied to the global demand for U.S. Treasury bonds. Foreign central banks hold dollars primarily in the form of U.S. Treasury securities. As those central banks diversify away from dollar reserves, as they buy gold instead of treasuries, as they hold yuan instead of dollars, as they invest in domestic infrastructure instead of American debt, the pool of buyers for U.S. government debt shrinks. And when the pool of buyers shrinks, the Treasury must offer higher interest rates to attract the remaining buyers. Higher rates on Treasury bonds flow directly into higher mortgage rates, higher car loan rates, higher credit card rates, higher borrowing costs for businesses. The de-dollarization trend is not just an abstract geopolitical story. It is a direct mechanical driver of the interest rate environment that every American borrower lives in. The third hidden layer is the gold accumulation that is happening simultaneously. Central banks around the world, particularly in the global south, in the BRICS nations, and in countries that have experienced or fear dollar-based sanctions, have been buying gold at the fastest rate since the 1960s. For 2 consecutive years, global central bank gold purchases have exceeded 1,000 tons annually. China's official gold reserves have increased every single month for over a year and a half. Russia has been accumulating gold aggressively since 2014. Saudi Arabia, India, Turkey, Poland, Singapore, all accumulating. What central banks are doing when they buy gold is not a random investment decision. They are building the foundation for a monetary system that does not depend on any single country's currency. Gold is the only truly neutral reserve asset, and the countries that are moving away from the dollar are moving toward gold as the alternative anchor. When the new multilateral currency architecture is eventually formalized, whatever form it takes, it will almost certainly have a gold component. The accumulation happening right now is positioning for that future. Let me pull this out of the realm of geopolitics and central bank policy and bring it directly to your kitchen table. Because I know some people are watching this and thinking, okay, this is interesting, but what does it actually mean for me? Let me be very specific. The most immediate effect of a declining dollar share in global trade is inflation that the Federal Reserve cannot fight with conventional tools. Here is why. When the dollar was dominant, the United States could export inflation. When the government printed money, those new dollars flowed out into the global economy because the world needed them for trade. The inflationary pressure of money creation was spread across the globe, not concentrated domestically. As the world needs fewer dollars, as trade increasingly settles in yuan or in local currencies through bilateral swap lines, those dollars stay home. Excess dollars accumulate in the domestic economy, and excess dollars in a domestic economy are, by definition, inflation. The purchasing power of every dollar you hold erodes faster when there are more dollars chasing the same domestic goods and services, and no global sponge to absorb the overflow. The second direct effect is on your energy costs. If the petrodollar system continues to fracture, if more and more oil is sold in yuan, in rupees, in a future BRICS currency, the United States loses a structural advantage in energy pricing. Right now, because oil is priced in dollars globally, Americans effectively get a slight discount on energy imports relative to countries that must first convert their currency to dollars. As that pricing advantage disappears, American energy costs rise. Not because oil became more scarce, but because the currency structure that gave Americans preferential access to the global energy market has changed. The third effect is on the federal government's ability to manage its debt. The United States currently carries $33 trillion in national debt. For decades, that debt has been manageable because the world bought it willingly at low interest rates. Every percentage point increase in the interest rate the government must pay on its debt adds hundreds of billions of dollars in annual interest expense to the federal budget. That money must come from somewhere, either from higher taxes, from cuts to government programs, or from printing more money, which creates more inflation. The de-dollarization trend is the long-term structural force pushing interest rates higher in America, and the American consumer and taxpayer will feel that pressure for decades through higher mortgage costs, higher government borrowing costs, and higher inflation. Here's the historical context that the financial media consistently fails to provide. Reserve currency transitions have happened before. They are not unprecedented. They are, in fact, a recurring feature of the long arc of economic history. The British pound sterling was the world's dominant reserve currency for most of the 19th century and into the early 20th century. At its peak, the pound served roughly the same function the dollar serves today. It was the anchor of global trade, the preferred reserve asset of central banks worldwide, the currency in which most international contracts were written. And then it was not. The transition from sterling to dollar dominance did not happen overnight. It happened over several decades, beginning after the First World War. accelerating through the Great Depression and the Second World War, and effectively completing at Bretton Woods in 1944. By the time most people recognized that the transition had happened, it was already over. The economists and financial historians who study these transitions have identified a consistent pattern. The country that holds reserve currency status tends to run persistent trade deficits. It exports its currency to the world and imports goods in return. Over time, those deficits accumulate into a mountain of debt held by foreign nations. The foreign nations begin to question whether the debt will be repaid in full, whether the currency will be inflated away, whether the military and economic power that underpins the currency's value can be maintained indefinitely. Confidence erodes. Gradually at first, then faster. Alternative reserve assets gain credibility, and one day, the world wakes up and the old dominant currency is no longer dominant. The United States is currently in the middle section of that arc. The deficits are enormous. The debt is at historic levels. The foreign questioning is increasingly overt. The alternatives are being actively constructed. The difference between the pound's decline and the potential dollar decline is speed and disruption potential. When the pound declined, the dollar was ready, fully developed, backed by the world's largest economy, supported by the military and financial infrastructure of an ascending superpower. The transition had a natural replacement ready. The yuan is not yet that replacement. China's capital markets are not fully open. The yuan is not freely convertible. Foreign investors cannot freely buy and sell yuan-denominated assets without Chinese government approval. These are real limitations that prevent the yuan from immediately filling the dollar's role. What is happening right now is not a clean replacement of the dollar with the yuan. It is a fragmentation of the dollar-centric system into a multipolar system, where no single currency dominates the way the dollar did at its peak. And a fragmented multipolar currency system is, in some ways, more disruptive than a clean replacement. Because in a fragmented system, the efficiency gains of a single global reserve currency disappear. Transaction costs rise, currency risk multiplies, global trade becomes more complicated, and the United States loses the exorbitant privilege without any single country inheriting it, meaning the structural benefit simply disappears from the global system, rather than transferring to a new hegemon. Here is what the smart money is doing with this information. Because the people managing large pools of capital have already made their assessments, and they are positioning accordingly. Central banks globally have reduced their dollar share of foreign exchange reserves from approximately 70% in the early 2000s to approximately 58% today. That 12 percentage point decline, spread across the trillions of dollars in global reserves, represents an enormous shift in capital allocation away from dollar-denominated assets. It is the largest sustained reduction in dollar reserve share since the Bretton Woods system was established. The sovereign wealth funds of the Gulf states, enormous pools of capital accumulated from oil revenues, are diversifying into yuan-denominated assets, into gold, into infrastructure investments in Asia and Africa that are often denominated in local currencies or in yuan. The Saudi Sovereign Wealth Fund, the Abu Dhabi Investment Authority, the Kuwait Investment Authority, these are funds measured in hundreds of billions of dollars that are quietly reducing their dollar exposure. Major multinational corporations that conduct significant business in China are increasingly invoicing and settling those transactions in yuan to avoid the currency conversion costs and the geopolitical risk of dollar-denominated contracts. Apple, Volkswagen, BMW, Total Energies, companies with massive Chinese operations are building yuan-denominated financial infrastructure for their Asian business that further reduces their dependency on dollar transactions. So what does a regular American do with this information? Let me give you the honest, practical answer. The first thing you do is stop treating the dollar's dominance as permanent and start treating it as a privilege that is gradually being eroded. That shift in mental model changes how you think about your savings, your investments, and your long-term financial planning. A world of structurally higher inflation, structurally higher interest rates, and a gradually diminishing purchasing power of the dollar is the world that the de-dollarization trend is pointing toward. Your financial plan needs to account for that environment. The second thing you do is think about diversification in terms that go beyond stocks and bonds. Both stocks and bonds are dollar-denominated assets. In an environment where the dollar is losing global purchasing power, holding assets that are not denominated in dollars, commodities, precious metals, international equities, real estate, provides a hedge that a purely dollar-denominated portfolio does not. This is not a radical idea. It is the same logic that every large institutional investor uses when they construct a global portfolio. Individual investors have historically had less access to international diversification, but the barrier has been significantly reduced by modern investment platforms. The third thing you do is pay attention to energy. The petrodollar system is what you pay at the gas pump, what you pay in utility bills, what you pay in the embedded energy costs of every product you buy. As the petrodollar phrase and energy pricing becomes more volatile and less structurally favorable for American consumers, energy efficiency in your home, in your vehicle, in your lifestyle becomes a direct financial hedge. A person who uses less energy is less exposed to the energy pricing volatility that comes with a fractured petrodollar system. Let me leave you with the single most important framing for everything I have walked you through today. The dollar becoming less dominant is not the same as the dollar collapsing. The dollar is not going to zero. It is not going to be worthless by next year. The people who tell you that the dollar is going to zero by some specific date are either lying to you or do not understand the complexity of global currency transitions. What is happening is slower, less dramatic, and in some ways more insidious than a collapse. It is a gradual dilution, a slow erosion of the structural advantages that the dollar's dominance provided to the American economy and to American consumers for 80 years. The 30% figure for yuan trade settlement is a milestone, not an endpoint, not a crisis moment. A milestone in a transition that has been building for 15 years and will continue for another 10 to 20 years. But milestones matter because they mark the passage from one phase to another. And this milestone marks the passage from a world where the dollar's dominance was unchallenged to a world where it must be defended, maintained, and managed, rather than taken for granted. The countries driving this transition, China, Russia, the Gulf states, the BRICS nations, are not doing it out of spite. They are doing it out of rational self-interest, for exactly the same reason that the United States built the dollar-centric system in 1944, because controlling your own currency's role in global trade is a source of profound economic power. China is doing what every major power throughout history has done when it had the economic weight and the strategic patience to do it. It is building an alternative system while the existing power holder is distracted, over-leveraged, and politically unable to reform. The Americans who understand this transition, who see it for what it is, who adjust their financial thinking accordingly, who do not wait for the evening news to explain it to them, are in a fundamentally different position than the Americans, who will be surprised by every incremental consequence of this shift as it becomes impossible to ignore. You now understand what is happening. The 30% number is not a headline. It is a warning. And like all warnings, its value depends entirely on what you do with it before the event, not after. Now I want to hear from you. I asked at the very beginning of this video, where are you watching from, and do you think the dollar will still be the reserve currency in 10 years? Drop those answers in the comments right now, and then tell me this. Does your country already use yuan in any trade? Are you seeing the effects of de-dollarization where you live? Are prices of things that used to be imported in dollars changing in your local economy? This is a global story, and the comments section of this video is a chance to actually hear how it is landing in different parts of the world. I read every comment. Let us have a real conversation. If this video gave you information that changed how you think about your savings, your investments, or the economic environment you're planning for, share it. Send it to someone who has all their financial life in dollars and has never thought about what happens when the dollar is no longer the world's operating system. That person exists in almost every family, in almost every workplace, in almost every neighborhood in America. Share this video with them. It might be the most valuable financial conversation they have this year. Subscribe if you are not already here and turn on that notification bell. We are tracking every development in the de-dollarization story in real time. Every BRICS summit, every new CIPS membership, every central bank gold purchase report, every petrodollar fracture event. You will get every update the moment we publish it. Because this story is not slowing down. The 30% number was 0% 15 years ago. The only question left is how high it goes and how fast. Stay informed, stay prepared. I will see you in the next one.